Hello everyone, this is Leah Harnish, Project Assistant at the Syracuse University Environmental Finance Center. On behalf of the Environmental Finance Center Network, I would like to welcome you to our webinar entitled Financing for the Future, Financial Longevity for Municipal Operations. This session is one of several webinars conducted by the Environmental Finance Center Network for Smart Management for Water Systems Project. The EFCN provides training and technical assistance to small public water systems in all 50 states and 5 territories to help local water systems achieve and maintain compliance with the Safe Drinking Water Act. Here you can see the various centers that make up the Environmental Finance Center Network. As you can see, these centers are spread all across the country from New York to Kansas to California. And here you see the areas of expertise that the Environmental Finance Center Network focuses on. Workshops, trainings, and direct assistance are provided on asset management, energy management planning, financial management, multi-funding coordination, leadership through decision-making and communication, managing drought, water loss reduction, collaborating with neighboring communities, multi-funding, water conservation, management and finance 101, climate resiliency, and workforce development. The EFCN also has a small systems blog. You can learn more about water finance and management through this blog. Blog posts feature lessons learned from our trainings and technical assistance, descriptions of available tools, and small system success stories. You can view our blog at efcnetwork.org. You will also have the opportunity to subscribe to the blog at the end of the webinar. In addition to the workshops, direct technical assistance, and webinars, as part of the Smart Management for Small Water Systems project, we are also creating a table of lists of major funding sources for drinking water infrastructure projects for each state and territory. Here is how you can access those tables. On the homepage, go to Resources and then click Funding Sources by State. This will take you to a map of the country. If you click on the state you're interested in, you will find a PDF table of the relevant funding sources for drinking water infrastructure for that state. The table looks at the image on the left side of the screen. For each funding program, it includes the name of the program, a short description, and contact information for someone who works on the program. At this point, I would like to turn the presentation over to our speaker. For our webinar today, we have Shadi Eskoff, the Senior Project Director at the Environmental Finance Center at University of North Carolina at Chapel Hill. Shadi, welcome and take it away.
Thank you very much, Leah, and thank you everybody for joining us today. So as Leah's switching over to me, I was asked to present on financial longevity for municipal operations, and that is a pretty broad topic, so I'm going to try to narrow it down just a little bit to kind of explain what I'll be talking about. So this is how I see it in my eyes. Here we have a timeline with different years. We're somewhere in the beginning of 2017 at this point. Usually when municipal operations look at financial management of their water and sewer systems, a very common thing to do, of course, is during the budget season, which for a lot of utilities around the country right now, this is budget season. The system will take a look at, the planners and the managers will take a look at their finances and really zero in on last year's information. What were the revenues and expenses last year? What were they actually compared to the budget? And then setting the budget for next year. What do they anticipate next year? And maybe even looking, another year or two beyond that. So it's a narrow focus between last year's numbers and the next couple of years. That's when you really drill down and look at the details of all the dollars and cents surrounding the water system. And that's great and that's important. That's how you set rates. What really happens, though, is anything beyond the next year or two gets a little fuzzy, especially if things are 5, 10, 15 years down the line. The outcomes and the financial picture for the municipal system is less clear. At the same time, the things that were more than a year ago, 2, 3, 4 years ago, get kind of left behind a little bit. We've moved on from those days and we're focused on the present. So during budget time, usually there's a focus on the narrow, the short-term period. My talk today is going to be focusing on the longer-term picture, and I'll be focusing on a big picture kind of look at financial operations for municipal systems, but also focusing on a few details on selected topics. If we want to talk about finances and being financially sustainable in the long term, we can be doing hundreds and hundreds of these webinars and to cover all the topics. But to narrow down to a 1 hour, I'm going to be a little bit more big picture with a few selected topics. So what I'll be covering today are three things. Assessing the financial performance trends in the recent past, and not just in the last year, but in the last few years. Then I'll be talking about clarifying what might be expected in the future. So looking at that 5 to 20-year horizon and thinking about what those expenses might look for the system. So it will help you in planning for those in the meantime. And the third thing will be I'll be showing some resources that are available to help water systems set plans for both the short-term and the long-term financial needs. My talk is going to be focused toward, the audience is focused towards small and medium-sized systems, but a lot of things that I'll be talking about here, of course, apply to the large systems as well. And if you're with one of the state agencies, having this kind of background knowledge will help you as you're working with the systems. I know that we probably have some utility commission people on here or PSCs on here. You're always welcome. And a lot of this information, of course, you might know, but there may be some tidbits that you could pick up and share with systems that you work with. All right, so let's start off by looking at assessing financial performance trends in the recent past. If I ask this question of any financial manager, and actually if any customer or any citizen asks the the water system manager these questions, it's expected that the system manager would know how to answer it, or the council person will be able to answer this. Is your water sewer fund self-sufficient? That's a broad question, all-encompassing. We want to make sure that the revenues and expenses the revenues that you're collecting are enough to pay for your expenses. You're not making too much of a profit if you're a government system, or if you're a non-government, then you're making the profits that were approved for you. Are you able to cover your debt service after paying for day-to-day operations? Debt has been a very common way of paying for large capital infrastructure. So a lot of systems have debt. Not a lot of, including a lot of small systems have debt. Do you have enough revenues coming in to pay for your O&M as well as your debt service? And that's a question that not just comes from customers and from the municipal government staff, but also from the funders themselves, of course. They want to make sure that they get paid back the loans that they've sent you. If your customers stop paying their bills, or if you end up seeing a decrease in consumption or in just payments in general, how long can you keep your operations going? How much cash do you have available to keep your operations going and you can pay for O&M expenses? Can your system meet its short-term obligations? There are a lot of ways to answer all of these questions. This is not a comprehensive list. This is just 4 questions of many questions that anybody can ask. But I'll be focusing on answering these questions using financial ratios, financial performance metrics, key financial indicators. You call them whatever you want to call them. Financial ratios that help you answer each one of these questions. And I'll go through each one of them individually. But I want to point out that we also have a whiteboard video. And Leah mentioned that these PowerPoint slides will be shared with you. They'll be both, posted online. Hopefully, it will also be sent as a link to you after the end of this webinar. So you'll have all of these links. My PowerPoint slides have a lot of links. Please wait for the PowerPoint slides to be posted so you can have access to them. There's no need for you to try to rush and copy these now. We have a whiteboard video that explains financial benchmarking in lay terms, and looking at an example or analogy of a man who owns a car, and does the man have enough money to keep maintaining his car and pay for the debt or the car loan and so on. It's a simple analogy, but it explains what financial benchmarking looks like. It's a good resource to have, not just for yourselves, but also you can share with the council. So they have an understanding of what some of these ratios that you might be, you might know and you might be talking about, they'll be able to translate into something that's more tangible. Where do water systems get started looking at financial indicators? Well, you all are local governments. Some of you are not. The local governments, you have audited financial statements every year. Those statements have all the data that you need to be able to calculate these ratios, and I'll show some examples. For non-governmental systems, anything that looks like an audited financial statement, like balance sheets or shareholder reports, might have some of the information as well that corresponds to the audited financial statements. So the first ratio I'll talk about is the operating ratio, and that's taking the total operating revenues, dividing it by total operating expenses. As a math enthusiast, I know that I want more revenues than expenses, so I want my numerator to be higher than the denominator. I want a ratio of more than 1.0. That means that the revenues I've collected in that fiscal year meets all of my operating expenses. A little bit trickier than that, or just to add a little bit of salt and pepper to this, operating expenses, if you look at your audited statements, will include depreciation. You can calculate this ratio in two ways. One, where you look at total operating expenses that includes depreciation, or you can subtract out depreciation from the total operating expenses. If you do that, if you subtract out depreciation, really what you're left with are your day-to-day operations and maintenance costs, because it's taking your just operating expenses and it's excluding depreciation, which is not an actual expenditure of a system. But if you do include depreciation, which is what we typically look at, it's looking at, this ratio will help you assess whether or not the revenues that you've collected were enough to pay for your O&M expenses, and also have some revenue set aside to be able to pay for at least the depreciation value, at least how much of your assets have decreased in value. Theoretically, meaning that by the end of that asset's life, you'll have generated enough revenues to be able to pay for the replacement value of that asset. Now, there's a lot of things that go on with depreciation, and we actually have a webinar that we've done focused only on the topic of depreciation. I'll show you the link for that in the next slide. But I just wanted to add to this discussion that depreciation happens. Obviously it's the loss of the value of the asset, not being restored by rehabilitation or refurbishment. It is an economic fact for every water system. What we're seeing, though, a lot of systems, when they're balancing their budgets, especially small systems, they're focused on the operations and maintenance and debt service fees or costs, and that's it. And they're not trying to put any depreciation into the budget in order to be able to generate enough revenues to meet depreciation. There are pros and cons to this, and again, you can listen to the other webinar to know about how to use depreciation in financial management. But I wanted to point out that depreciation is, it's a surrogate, maybe a weak surrogate for capital costs. So it might help you think about paying for capital in the future. I will also add to that point that capital costs usually exceeds the depreciation value. So even having enough revenues to meet O&M expenses and depreciation might not be enough to pay for all of your future capital costs. So here's a link to the recorded webinar that we did on depreciation. My colleague Glenn Barnes led that one, and we had the CPA sit in and talk about how to use depreciation. What does depreciation mean from a CPA point of view, and how you can use it as a system manager. And the webinar was called Demystifying Depreciation, How to Make Use of It, if you search for it on YouTube. So as I said, we want this ratio, the operating ratio, to exceed 1.0. Typically, you might even want to aim a little bit higher than that, because future capital costs need to be added to this, and future capital costs are higher than depreciation, like I said. So you might want to be aiming for a 1.1 ratio or something of those lines. The second ratio is debt service coverage ratio, and that one takes the difference between operating revenues and operating expenses, so what's left over, excluding depreciation. So we just take out, you're just looking at O&M expenses. So how much net revenues do you have after you've paid your O&M expenses? and then you divide that by your principal and interest payments. You absolutely want to have a ratio of greater than 1.0 here. You want to make sure that you have enough net revenues left over after you pay for salaries and chemicals and power and all that to pay for your principal and interest payments. But if you check your bond covenants, or if you talk to the funder, whoever sent you the loan, they might have very specific rules about what this ratio needs to be every year. And a lot of times it looks like they want a ratio of about 1.2 or higher, meaning that the funders want you to be able to generate enough revenues to pay for your O&M expenses and your debt service and have another 20% extra left over. And those are there for security, to make sure that you have enough money later on to pay for principal and interest in case revenues drop. So check your bond covenant, see what that ratio is. Oftentimes it's greater than 1.0. The third indicator is days cash on hand. And that one's looking at your unrestricted cash, which you'll find in the statement of net position, I believe, and dividing it by the average daily O&M expense. And again, O&M expense will be total operating expenses minus depreciation, and divide that by 365 days. And if you take a look at the unrestricted cash and divide it by the average daily O&M expense, it gives you a number that actually means how many days of cash on hand you have available. If you calculate this and it tells you have 102, it means that you have enough cash to pay for 102 days of average O&M expenses going forward. So if you don't get any more money coming into your fund, you have enough money right now as unrestricted cash to be able to keep your operations going for another 102 days. What's a good target here? That one's very subjective. It's not as clear-cut as the previous two indicators where, 1.1 or 1.2 is a very clear-cut answer. This one's really a subjective one. How many days of cash on hand would you feel comfortable having, or would your council feel comfortable having? We've seen a lot of systems that aim for about 180 days as a minimum, so they have enough to cover 6 months of O&M. We've talked to systems that like to have at least a year's worth of days cash on hand. There are some systems that aim higher. They aim for 2 years' worth of days cash on hand, and they do that partly because of credit rating agencies like to see high numbers for days cash on hand, so they're trying to increase their credit ratings. But for a lot of systems, if you see that your days cash on hand is 5 or 10, that might be worrisome. If it's 90 or 100, it's still lower than the 180, but it might not be a bad thing. It might be enough or sufficient for what you're trying to do. The last ratio I'll talk about is the current ratio. Sometimes it's called quick ratio, and that's looking at your unrestricted current assets, excluding things that are prepaid or inventory, things that you can't really access quickly, and dividing it by your current liabilities. And you want a ratio of greater than 1 for this one, because you want to make sure that you have unrestricted current assets that you could tap into to pay for your current liabilities and not be caught short-handed, basically. All these numbers that you need to be able to calculate these ratios can be found in the proprietary funds section of the audited financial statement. If you have multiple proprietary funds, then obviously we're just talking about the water and sewer funds, either individually or combined. I'm going to show you just screenshots of an actual town's financial statement to show you kind of where these numbers might be. In the statement of revenues, expenses, and change in net position, you'll find your total operating revenues, you'll find your total operating expenses, and you'll find depreciation as a line item under operating expenses. In the statement of cash flows, you'll see under the cash flows from capital and related financing activities, line items for principal and interest payments. Sometimes these can be combined. If you're following GASB rules, it should be somewhere in this section. You should be listing what your principal and interest payments on loans and bonds are. And the statement of net position has the assets at the top and liabilities on the bottom. Under assets, you'll have, under current assets, each of the line items that you might need to calculate two of those ratios that we talked about. So cash and cash equivalents, that's unrestricted cash. And you might have line items that say restricted cash, so you might have to subtract that out of some of your calculations. And then on the liability side, you have your total current liabilities, and usually we would subtract out deposits from current liabilities when we're calculating the current ratio, partly because we don't anticipate that all of the customer deposits will be due immediately. Those things will be phased out over time. So current customer deposits we subtract out of the current ratio. An important point when you're looking at financial indicators, we've talked to systems that have produced the financial statements and just submitted them to where they need to submit them and never look at them again. We've talked to systems that look at them and analyze them and share the information with the council. Some of them even calculate these ratios. And here's an example. This one's a made-up example, but it's illustrative of what I'm trying to talk about here. So some of the systems will calculate these ratios and share them with council and say, look, our operating ratio is 1.02 in the last fiscal year. Our target was 1.0, so check, we did good here. Our debt service coverage ratio is 1.15, which means we had enough money to pay for O&M and principal interest payments. I don't know if their bond covenant requires a 1.2 ratio or if 1.0 or 1.1 was enough. Sometimes you might see a 1.1 as the minimum target. So for this one, I'm going to put a question mark. It might be good. It might be slightly below the target. Days cash on hand is 145. Maybe that system had a target of 120. They look good. The current ratio is 1.2. They want at least 1. They look good. So looking at last year's financials, everything seems to be going great. So we're on the right track. That's the conclusion that one would come from looking at these numbers, which is true, which is accurate. But that's just by looking at 1 year. I'm proposing that every system should be looking at least for a 5-year trend. So calculate these ratios for the last 5 years, or longer if you have them. Because here's what it looks like if you put these numbers or you map these out over a 5-year period. So this is the same illustrative example. We said that the operating ratio is a 1.0 and the quick ratio I think was a 1.2. So all these numbers look good. What you see here are graphs of indicators, and the little dotted blue line shows the minimum target. So anything above that is good, anything below that is bad. And then each year is a separate black dot here. So they look good. I mean, everything looks to be above the blue line for at least for these 4 indicators, and for the debt service coverage ratio, they were below the blue line in the past 5 years. So in this case, the blue line was set as 1.2. If the bond covenant said 1.2, then we said that 1.15 might be good, might be bad. We're not sure yet. But if the past 5 years they've not met their 1.2 target, that's a bad sign. So all of a sudden that 1.15 ratio doesn't look quite as good anymore. And then looking at the other ratios, the 1.02, the operating ratio here was good, it was above target, and each year it was above target, but you can see the trend line is going down, which means that revenues, if we don't raise rates or if we don't control our expenses next year, if these trends continue, we might expect that next year's expenses will exceed our revenues. And quick ratio is just jumping all over the place, which normally happens when you look at quick ratios because it's a snapshot of 1 day in time. But it's also very volatile and inconsistent, and there were some years that seem to be much better than the 1.2 ratio. Days cash on hand is one that I'd be worried at if I saw this graph, because it looked like 3 or 4 years ago they had about 250 days of cash on hand, and now they're down to 145. So they're eating away into their unrestricted cash. So looking at the overall picture here, yes, the ratios were above the blue dotted lines for 4 out of 5 indicators, so they were okay for most of the years, but the trends are showing that things are not improving. They're getting a little bit worse. So that means, I think, the new conclusion would be we were doing okay, we are currently okay, but something needs to change going forward. Either we need to control expenses or we need to raise our rates because at current trend levels, we may be in trouble next year or the year after that. So trends are very helpful when looking at financial indicators. We have a tool that's available that's free for use. You can download, it's an Excel tool, you download it and use it yourself. That will help you calculate these ratios. It's called the Financial Health Checkup for Water Utilities. We have the links up here. Again, you'll see the links when you download the PowerPoints. And how the tool works is you pull up your financial statements for the past 5 years. You put in these numbers that we talked about, total operating revenues, total operating expenses, and so on, for the past 5 years, and you hit go, and it will automatically calculate all these graphs that we just looked at for the past. And if you don't have 5 years, if you just have the last 2, put those 2 years in, and it will show you the 2-year trend line as well. So this tool is available for anybody to use. It's free to download and use. All right, so I'm going to switch gears now and talk about the future. We just talked about assessing the past and how we performed in the past. And from that, you might have ideas about changing. We need to raise our rates because it looks like at current rates, next year's trends might, the trend lines are showing the decreases. But now let's look at long-term future. 5, 10 years, 20 years from now. What are those expenses? The future is always fuzzy. And after going through this part of the webinar, it's not going to answer all of your questions right away, but I'm going to be talking about asset management planning and capital improvement planning, which will help you at least identify some things and to have a little bit more concrete numbers to kind of paint the picture of the future a little bit more clearly as you set your rates, as you look at budgeting for the future. A couple of really big picture items here to talk about before digging into the asset management planning for water systems. Looking at the trends of capital expenses or capital outlays in the past, I don't know, few decades, 4, 5, 6 decades in the U.S., we're seeing some trends that might be helpful for you to understand. One is that the federal government, and these are all inflated to 2014 dollars, so the rate of inflation is already adjusted for here. Federal government used to, in the 70s and 80s, fund a lot of water systems, and most of that time it was in terms of grants, and that's been decreasing over time. And lately it's been mostly in terms of loans. Now, WIFIA is now open for business, and we might see an increase in total federal spending on water and sewer systems, but those again are in terms of loans as opposed to grants. State and local governments, though, in general, and when we say state and local governments, it's really the vast majority of local governments. Local governments as a whole are outspending the federal government significantly on water and sewer systems. And this is for, I believe this is for capital expenses. And we don't expect that trend to go down too much. It went down in the past 5 to 6 years around the recession time after the stimulus money had been run out. But these trends will go back up again because the capital expenses that were postponed are going to be coming back on in the future for the system. So the main point is the onus is on local governments to be able to pay for their capital infrastructure. Don't expect the federal government to come in with grants and offer you quote-unquote free money to be able to pay for infrastructure. So it's up to the systems to think about the long term and to plan for the long term to be able to pay for these really expensive capital equipment. I will also make a comment here about PPPs, or public-private partnerships. You've probably been hearing about that recently. You'll keep hearing about that going forward. But because of this situation where local governments are spending more and more and more on capital infrastructure, at some point it gets really expensive for the customers to be able to bear that cost. A lot of systems are now starting to look at partnering with the private sector to be able to pay for some of these capital infrastructure, and that's a whole different kind of webinar that we can talk about in the future. Another trend to keep in mind are the construction costs are going up at about 2.7 to 3% per year, which is actually faster than the rate of inflation or the CPI inflation. So keep that in mind, that construction costs, labor, or construction labor, lumber, concrete, steel, construction materials are going up at about almost 3% per year. And that water use is declining for a lot of systems, which for a lot of systems that means lower revenues, because the vast majority of revenue that the water systems are getting come from the volumetric charges that they set on their customers. So if customers are using less water, they'll be charged less less for that water, and so revenues will go down unless you raise your rates, which then leads to affordability problems for some customers. So it's not a pretty picture. Costs are going up. The local governments will end up having to pay for most of the costs going forward, and these costs keep growing. And that customers are using less water, which means it's harder for the systems to generate the revenues to pay for that infrastructure. So planning is really vital here, and that gives you, looking at the long term will help you think through options and alternatives, and how do you adjust your capital plans, or how do you change your capital plans, or work with the private sector, whatever the scenario is or situation is that will help you generate the revenues that you need to be able to pay for your infrastructure going forward. You need time to be able to do that. It's not something that you can do in that same year. You have a construction project that's about to start, and now you're trying to figure out how to pay for it. So long-term planning is critical. There are a lot of things that affect the long-term plans. I'm not going to go through all of these. I'm going to focus on capital expenses, both to rehab and replace existing infrastructure and to add new infrastructure. So we'll talk about asset management planning and capital improvement planning. Asset management plans, I'm sure everybody by now has heard of asset management plans, so just as a quick recap, there are 5 core components of asset management plans. The first is an inventory of the assets that you have, so literally just a list of all the assets. Where are all of your pipes? What size pipes do you have? Where are they? What do you have in the treatment plant? Where are your pumps, your pump wells, all that stuff? And the current state of it. So are they in good condition? Are they in poor condition? Do they need replacement in the next couple of years? Are they brand new and they can last for another 20 years? So have some kind of an assessment on the asset of, or the state of the assets. Level of service is an understanding between the system managers and the customers about how, what is the level of service that the customers and managers are expecting. Are your customers wanting to have the purest water they could ever get, nearly distilled water? They don't care how much it costs. They just want really clean water. They never want to see a leak anywhere. Or are they, willing to have the bare minimum, just as long as you're meeting the bare minimum federal standards on drinking water quality? We want you to do the least that you can do, because we don't want to be paying more for that service. So, or is it somewhere in between, which is usually the case? Having an understanding of that level of service helps you think through, all right, well, if this asset or this pipe is leaking, and we're rating the current state of that asset as relatively poor, is it important for us to be able to fix it now because that's what our customers are demanding, or is it something that we can push forward or delay because it doesn't affect the level of service that our customers want? So having that understanding of the level of service helps you think through the prioritization of when you get to work on specific assets. The criticality of the assets is when you look at how important that asset is, and I have a slide about that, so I'll talk about it then. And then life cycle costing is when you start putting the financial numbers in. So if you have an idea of, the pump needs to be replaced 5 years from now, what's it going to cost to replace the pump, and also the new pump, what are you expected O&M costs going forward? Is it going to be using more energy or less energy? And you need to be able to factor that into your budget or your long-term financial plans. Because as you change your assets, your O&M expenses will change as well. And then the long-term funding, is looking at all the capital expenses going forward, whether it's paid for by cash or by debt, and coming up with a plan for how you're going to collect, how you're going to be able to generate those revenues, whether you're going to be applying for subsidized loans, whether you're going to be applying for grants, competing for grants, I should say, or if you're going to be saving ahead of time and generating the revenues that you need to pay for your capital infrastructure. So I talked already about the current state of the assets. Again, it's just a list of the assets, and including where are they, what's the condition, what's the useful life remaining for that asset. Here's an example of what it might look like. You can create it in any way you want. If you don't already have an asset management plan, feel free to contact us, and we'll help you work through this process. We have people in the Environmental Finance Center network that will work directly with the systems to start off creating an asset management plan. We've already talked about level of service, and on the criticality parts, there are two questions to ask about each of the assets. What's the probability that this asset will fail relatively soon? And then what's the consequence of that asset failing? And the consequence piece is important because if you only have one pump and that pump delivers water to half of your customers and that pump fails, that's a near catastrophe. But if you have redundancies built into the system, if you have multiple pumps, and if one pump goes offline, the other pumps are able to keep delivering water, then the criticality of that pump, of that individual pump, is not as important as in the first example. And the probability of likelihood of failure is just how close is this asset to failing. So knowing these two things will help you prioritize which of these assets you need to work on first. Obviously, if something is highly likely to fail soon and it's the consequence is very high, it's a highly critical asset, you need to be working on that very, very soon, as opposed to something that might be high probability of failure, but a very low consequence of that failure. You could maybe push that off a little bit, or you could plan for it and schedule it after you've worked on the more critical assets. So asset management planning helps you think through your entire list of assets. Here's an example where you list all of your assets, you talk about your condition, the expected life, how much useful life is remaining, what the importance of that asset, if there are any redundancies built in, and then prioritize it. So in this case, the chlorinator has a useful remaining life of 2 years. It's mandatory. It's the only chlorinator they have. There's no redundancy. That is clearly a highly critical asset that they should prioritize. So they've prioritized number one. And then the other assets, like up here where you have a well that's in good condition, 21 years of life remaining, needed for service. There is redundancy, but they might need another backup. So that one's not rated quite as highly. So having that kind of look at your assets helps you think through, all right, let's schedule the chlorinator next year, and let's schedule this well. Well, it looks like we have 21 years left remaining, so 21 years from now. Asset management plans, so once you've prioritized your assets, start coming up with a timeline on when to replace and rehabilitate your current assets. And think in terms of grouped projects. And what makes sense when, should you work on a particular part of the distribution network together, or do you space things out? So think about in terms of how you group these projects together to make your projects more efficient. Asset management plans can be for longer than 20 years. Some asset management plans might be 50 years long. It doesn't matter how long, as long as you have an idea or a plan for replacing or rehabilitating even your newest assets. So if you brought in something and you expect it to have a 40-year lifespan, then 40 years from now, you should show that you're going to have to either replace it or rehabilitate that asset. Or you might have some rehab projects between now and then. You don't have to figure out how to pay for everything 40 years from now. The asset management plan, even though I said you can start putting in numbers into these things and have long-term financial plans, doesn't mean that you need to know, I have a project 20 years from now, I'm going to be applying for an SRF loan for that project 20 years from now. You don't have to go into that much detail. But that's where capital improvement plans come in. So capital improvement plan takes your asset management plan, zeroes in on the next few years, shorter time frame, maybe 5 years, sometimes they're 10 years. I've seen some 20-year CIPs as well. They're a little bit less common than a 5-year or 10-year CIP, but a 5-year is kind of a very common time frame. Think about the next 5 years, think about all the projects, and then have a really concrete plan for how you're going to pay for each of these things. You're going to be applying for SRF loans, you're going to be trying to save money. You know that a project's going to happen 5 years from now that you want to pay for in cash entirely. Well, you might need to raise your rates today so you can start saving up for it, so 5 years from now you have the money to be able to pay for that asset. Make sure that the CIPs include the projects not listed in the asset management plan. Asset management plan looks at your current assets, at what you have currently in the ground and operating. Well, you might have to add some new assets, so they're not going to show up in the asset management plan, but they should be shown or included also in the CIP. Here's what a very, very simple CIP table would look like. you have all of your projects or all of your assets that you're planning on either adding or replacing or rehabilitating, like painting of a water plant or adding additional storage tanks. You have your years listed, so the 5-year C.I.P, and you have the cost of each of these projects. So you can see down, in this fiscal year, these are the 5 projects that's going to happen. Here are the other 5 projects. Here's the total cost in each of those 5 years. So it's a very simple kind of a spreadsheet that you can create. So now that you know what your capital plan is, the question is, how are you going to pay for all these projects? And there are 4 ways to pay for capital projects in general, as a simple kind of framework, thinking about it. One is you pay as you go. So from your current receipts, whatever money you're making this year, if you happen to have a surplus this year, great, let's use that surplus to pay for a capital project. We know that a lot of systems use that method, especially small systems, if they don't already have a C.I.P, because they're not planning 5 years from now or 10 years from now. That system is fine, but a lot of years it might be very difficult to generate that surplus that you need to be able to pay for capital projects. So other systems, though, have a very sophisticated plan that looks at their capital projects, and they do very intentionally plan that they will have rates high enough in that 1 year to be able to pay for projects in that 1 year. So they, pay-as-you-go model works for both systems that do planning and systems that don't do planning. You can save in advance and pay for capital infrastructure. So, basically by having reserve funds, raise your rates now, put the money into the reserve fund, have that reserve fund ready to be able to pay for capital projects. You can pay later, so that's where debt starts coming in. You can borrow you can have a bond, you can borrow a loan, or you can have a loan, and the money will come in, and you have to pay it over the life of that loan. So 20 years from now, you'll pay for that asset. Or you can compete for grants, and grants are basically, essentially they're taxpayer money coming from wherever. So if you're getting federal grants, it's taxpayer money that's coming from all over the country. If it's state-created grants, then it's coming from your states. Grants are obviously very attractive for systems. Everybody would love to have grants. They're obviously very limited in terms of how many projects they can fund and how much of a project they could fund, and they're very, very competitive. So we know that in some states, it's highly unlikely that systems would get grants. And we've been, in all of our webinars and presentations, we talk about how systems should not be relying on grants when they're thinking about long-term funding. But if you have a plan and you talk to the administrators of the programs and you think that your project has a very high likelihood of qualifying for grants, then you could plan for that as well. Typical sources of external funding are bonds, loans, and grants. Bonds are revenue bonds, GO bonds. Loans can come either from commercial banks, so just regular commercial loans with relatively high interest, the market rate interest, or you can have subsidized loans. So the USDA loans, the state revolving fund loans, state agencies, and now WIFIA have its loan program up and running. Or you can get grants from the CDBG, Community Development Block Grants, which is administered by HUD, Housing and Urban Development, and the state agencies, or the Economic Development Agency, Appalachian Region. There are different agencies that offer some grants, especially state agencies. As Leah mentioned, if you're wanting to know where can you access subsidized loans or grants, we've mapped out for each state all of the different subsidized grants and loans programs that we could identify, and we've posted them all on this web page. So if you can see the link up here. Again, the PowerPoint slides will be posted. If you go to that web page and you click on your state, you will download a PDF table that shows each of the subsidized funding program, what do they fund, what the deadlines are, the contact information, and the website. So you can learn more about what's available to you. Keep in mind that capital investments, that those high capital projects that we're talking about right now, is just the tip of the iceberg. I mentioned this a little bit earlier. The construction cost or the capital cost when you first acquire that asset obviously is very high, and it's very steep, and it's something that you need to be planning for, but that's not the only thing you have to think about. You also have to think about when your asset goes online, your operations and maintenance costs will go up, or will be adjusted based on that new asset. You might have a refurbishment, once or twice over the life of that asset, and at the end of the life of the asset, you might even have a disposal cost. So if you think about the life cycle of that entire asset, the capital costs might be somewhere between 30 to 40% of the entire lifetime life cycle costs of that asset. So keep that in mind when you have a financial plan. So, I recommend looking at a financial plan that creates a kind of a 20-year horizon. You don't have to be super accurate 20 years from now, but at least have a concept of how your costs are going to go up and down based on what you do with your capital project. So now we're entering the third and final piece of this webinar. And at this point, I want to recommend everybody that you're welcome to submit questions at any time. This might be a good time to do that because I'm going to be talking about resources that you can download and use on your own. So feel free to submit your questions. We'll have a couple of minutes towards the end to answer some of your questions. So I want to talk about resources that are available for water system managers and the technical assistant providers, the consultants, the rural water associations, RCAPs, and so on. Resources are available for anybody really to be able to download and use to help water systems plan for the future. And again, most of these are geared towards small and medium-sized systems, but they could be used for larger systems as well. We've already talked about the financial health checkup tool for water utilities that looks at the financial performance metrics of the past 5 years of the water fund. So I won't talk about that again. We've just talked about the funding tables or the funding sources by state. Another tool that we have available is a spreadsheet tool. It's called a water and wastewater rates analysis model. And you can find it on either of these two websites. And what that is a spreadsheet where you put in what your expenses are going to be going forward, your capital expenses, your debt service, your O&M expenses. You put in what your rate structure is, and it will project for you the next 5 years whether the revenues that you'll be generating from your rates and some customer water usage patterns that you'll have to enter in as well. It will calculate what your projected revenues are and what your projected expenses are, and you can see whether or not your rates, as you've set them, will generate enough revenues to meet all of your expenses. If not, there's the option in here to be able to change your rates. So you can create different rate scenarios where you can adjust your rates and see how those adjustments might affect your revenue generation. So how high do your rates need to go up in order to pay for your expenses if you've noticed that there's a gap being projected. So it's a cash flow model. It's relatively simple to use. We've worked directly with water systems to use it and to plan for their financial for the next few years. So for rate setting, this is a very helpful tool. There's a separate tool for capital planning specifically, and it's called Plan to Pay Scenarios to Fund Your C.I.P. In this tool, again, it's a free tool, download it as an Excel spreadsheet. You put in all of your capital projects. So if you have a C.I.P., great, you're halfway there. Put in all of your capital projects. Put in when you expect each of these projects to begin construction. Put in whether you want to pay for that, what the cost, of course, of that capital project will be, how you want to pay for it, whether it's going to be from your reserves, so from cash receipts, or from debt service, and if it's debt service, what are the terms of your loan. By putting in that information, and also specifying how early you want to start raising rates in order to pay for a particular project, the tool will automatically calculate what the net effects will be on your rates. So it will say, okay, here are all your projects. This is how you said you want to pay for them. To pay for all these projects, your rates will have to go up 4% next year, 10% 3 years from now, 5% the year after that. It will try to smooth those rate increases for you, and it's a great tool to be able to do something very particular, which is to see what your C.I.P. will do to your rates or might do to your rates. So what's the effect, what's the impact to your rates based on the current C.I.P. and the way that you're planning on paying for your C.I.P. If you don't like the results, if you think that rate increases are way too high too quickly and you want to phase things out, this is where the scenario part comes in. You can go back and you can change when you expect the project to start or how you want to pay for the project, where you switch it from capital reserves to debt service. Change the way that you pay for the project, and it will automatically show, again, the changes to the impact on your rates. So that's a tool that's available for everybody to use as well. EPA has produced, they produced this tool several years ago. I don't remember exactly when, and they've been maintaining it, so it might look a little bit different than this screenshot. It's called C.I.P, Checkup Program for Small Systems. It's an asset management and C.I.P tool, kind of all wrapped into one. You start off by listing all of your assets, and you can start planning when you'll replace all these assets. And the best thing about this tool, in my opinion, is once you have all the data entered and you click this Print My Checkup Reports, it automatically creates a Word document that is your capital improvement plan. It has all the headers, it has everything laid out for you. So it's a really good tool to do that. It does take time to put in all of your assets into here. So if you don't already have an asset management plan, this might be a good thing to use if you don't have a lot of assets, especially. If you need help working with CUPs, I believe there are some people at EPA who can help you use their program, and they also do some webinars to kind of explain the use of CUPs. There are guidebooks to help you answer questions or to find information about specific things. So for rate setting guidebooks, AWWA has a few manuals. I don't believe they're free. I think if you're a member of AWWA, some of these things are lower cost. But these are available resources to help you think through in detail how to set rates appropriately and defensively and equitably. There are other versions of that, like EPA produces some guidebooks that are available for free as PDFs, especially for small systems. I think they have a whole series of guidebooks and resources for small systems on their website. This is one of them. Setting small drinking water system rates for a sustainable future. So there are some resources available to answer some detailed questions. They also have a good web page that wraps all of their resources on asset management together for small systems in particular. So there's a link to that web page. Included on that web page is a reference guide for asset management tools. So I've mentioned CUPs, I've mentioned the plan to pay scenario for paying for your C.I.P. This is a guidebook that shows a whole list of a lot of other tools available to help systems get started or to do asset management planning. It might not be comprehensive. I'm not sure. I mean, they haven't updated it since 2014, so I'm not sure what's in or what's not, because things are constantly changing in this field. But at least it has a lot of really good references of some things that you might not be familiar with yet. Leah mentioned that we do blog posts, and those blog posts, some of these graphs that I showed earlier on that showed state and local government spending or the construction costs are going up, we do blog posts that share information with systems to kind of enhance your general knowledge of the financial management of your water system. So if you want to stay in touch or find out about the latest research on water and sewer finance trends in general, or tips and guides to how to manage water systems based on case studies or based on information we've collected from a lot of other places, please feel free to go to either one of these web links and subscribe. There's no fee to subscribe to those blogs. And I think we post about once a week to one of these blogs, so that's the most that you'll be getting. And then last but not least, this website is really kind of all-encompassing of all of these things I just mentioned. We post everything that we have on the efcnetwork.org website. So that's Environmental Finance Center Network.org. If you go there, you can sign up for free webinars and workshops in your state, live in-person workshop. And we also record. So all these webinars that we do, this one included, we record the webinars and we post them online for people to watch later on. Again, they're available for free. You can sign up for free in-depth direct assistance. So you can work with us. Say you have a question about rate setting, or you want to look at your capital improvement plans and how you're going to pay for that in the future, or you have particular questions about reserve funds or depreciation. Feel free to click on that link up here and sign up to have one of the EFCs contact you and schedule a time to talk. And we do multi-day, multi-hour direct assistance. Again, it's no cost to you thanks to a cooperative agreement that we have with the EPA. So EPA is paid for this, and we're providing the service to small systems who supply water to 10,000 people or fewer, so about 4,000 accounts or fewer. And then all these resources, the tools, the guidebooks, we post under the resources, including the PowerPoint slides as well sometimes. So if you go click on resources, you'll find a lot of information in there that you can download and use on your own in your financial management. So that's the end of my presentation part. I think it's time to answer questions. I'm going to keep my slide up here so you can have my contact information. But Leah, do you have any questions for me to answer?
Yeah, we do have some questions for you today. The first question is, in computing the operating ratio, should the operating expenses in the denominator include debt services, short-lived asset reserves, and other reserves, or are these amounts just the pure cash operating revenues and expenses?
Okay, good question. And I don't want to cheat, but I want to say it depends. And the answer really is, it depends on what you want that ratio to be. I mean, I'm showing, it looks very clear-cut. I'll pull back the slide. So these ratios are pretty standard ratios. And the way that this ratio is shown, operating revenues divided by operating expenses, debt service will not show up in that. But if you want to calculate a ratio that shows that your revenues are enough to pay for operating expenses and also debt service and other things, you create your own ratios and set that, and use that internally or use that in your communications with the council. But the typical operating ratio, when we're talking about total operating revenues and total operating expenses, debt service wouldn't be included in here because debt service wouldn't show up under your total operating expenses section from your audited financial statements. So that brings up a good point that this ratio, that's why I like having that's why I like to include depreciation in here, because at least it encompasses somewhat or a surrogate of what capital costs might be going forward, but it's not very precise. So it's a good ratio to look at your O&M expenses and maybe some of your capital expenses, but it doesn't include things like your current debt service or even future capital projects. Okay.
Thanks. And we actually have one more question before we run out of time. The next question asks, doesn't pay-as-you-go result in large fluctuations in rates, both upward and downward fluctuations?
Yes. So if you do pay-as-you-go only as your own way of paying for capital infrastructure, and I mentioned that you can plan for these things, so you know that a capital project is going to happen 3 years from now. It's going to cost you $200,000. So you're going to raise your rates 3 years from now, or maybe even 2 years from now. That will, if you just do it that way and then lower your rates the year after that because you don't need high rates again, it will result in high fluctuations. What systems typically do, though, is if they know that they have a project coming up 3 years from now, so this is where the financial planning comes in. You know they have a project coming 3 years from now, it's usually best to start raising rates slowly over time and put money in reserves as opposed to doing the pay-as-you-go. The other alternative is systems build up their reserve funds enough to be able to weather these fluctuations. So they have a reserve fund that would be available, they sometimes call it a rate stabilization fund. It's a fund that's available to be able to, you can just borrow that money. It's almost the same thing as saving ahead of time to pay for capital infrastructure. You have a fund that's available that will help pay for capital infrastructure from your reserve funds, as opposed to getting debt service, so that you don't have to raise rates significantly that year. And then so you draw down that fund when you have capital projects, and then you build it back up again when you don't. So that way you can smooth out your rate increases over time and don't have to have those spikes in those years to pay for capital infrastructure. So really those two alternatives are talking more about the idea of start planning, start raising rates slowly over time and saving money ahead of time to be able to pay for capital infrastructure, as opposed to just relying on current receipts of that 1 year, which is the most volatile way of paying for infrastructure.
Thank you. And unfortunately, we're out of time, but quickly before we wrap up, I have 2 more polling questions for everyone. The first asks if you would like to sign up for the blog, but with the Environmental Finance Center, please click the following. And the poll will close in 3, 2, 1. Our second question for you before we end asks if you are interested in receiving free in-depth technical assistance for your water system. And the poll will close in 3, 2, 1. I'm also going to be pushing through a link in the chat box for a survey for today's webinar. If you have a chance, please take some time to tell us your thoughts about today's webinar. You'll also receive a follow-up email tomorrow with this link. I'm also pushing through the videos and webinar mentioned in today's webinar. In addition, attendees will receive a certificate of attendance for viewing the webinar today. This webinar has not been submitted to licensing agencies for pre-approval of continuing education credits. AWWA recommends that you check with your licensing agency to learn about its criteria, rules, and what you need to do in order to receive credits for your attendance. It is your responsibility to verify this information with your licensing agency. If you need assistance in applying for credits to your licensing agency, please contact educationservices@awwa.org. This email was also pushed through in the chat box. You will receive an email from AWWA in 10 to 30 days after the webinar with a link to access your certificate. Thank you, Shadi, for a great webinar. We all learned a lot, and I hope everyone has a good day.
Thank you, everybody, and feel free to contact me if you have any follow-up questions.